While talking about bull markets during this current decline seems premature, eventually what's going to happen is that upside will resume. And when it does, being ready with a plan of attack for how you're going to take advantage of the fresh upside moves, it's pretty vital. Now, there's no need to reinvent the wheel. Okay, you don't need elaborate trading strategies that are full of redundant indicators and candlestick patterns. You don't need any of that. Before we get started, if you could just hit like and subscribe to our channel, that'd be pretty helpful. And of course, any questions or comments after this video, you can just pop them below. Now, when we determine the trend, and we can use two simple chart patterns that tell a tale about the instrument you're trading, we have an approach that we can use. And once that reversal is in play, you can set yourself up with a trigger and you can get into a trade. Now, this has been a tried and tested approach for decades and in any market condition. We're going to talk about just the upside in this video. And if you just simply reverse everything that you're going to hear and see, you just get involved in the downside. When we're talking about chart patterns, when we focus on the underlying causes of why they're performing, we're looking at it from the best approach. Yeah, you can just trade the pattern without understanding it. However, when you know the imbalance that's causing it, it's a lot better because then you could begin to grade the pattern. You could trade the best ones that are setting up and you could just skip the rest of them. In essence, chart patterns form when there is an imbalance of upside and downside interest. Now, eventually one side is going to take over. In our case here, it's going to be the upside, and the trend's going to continue. The two patterns that we're going to focus on when we're considering the upside, bull flag and the ascending triangle. Only two patterns out of the many that are available. But a lot of chart patterns are just slight variations of another. Again, know the imbalance, and you don't need a truckload of patterns to look for. So when we think of the bull flag, let's think of it as a pause in the uptrend of the instrument. We see some profit taking, and also, yeah, we could be seeing some shorts entering the market, but eventually all that begins to stall. We get a reversal and off again to the upside. Now, pullbacks will come in two general forms. The one here is a complex pullback. This is where price tries to resume to the upside only to be met with fresh sellers. Once longs see the potential lower high being put in, some weak holders are going to exit. But eventually, if the uptrend is going to stay intact, price is going to need to stop putting in lower lows and start taking out the recent swing highs. The second variation is just a one leg move down, and then we get a resumption to the uptrend. But for both variations, the key is that we do not want to see sustained momentum during the pullback phase. When we're looking to get long, we don't want to see strong selling, right? We don't want to see new sellers entering the market. We don't want to see any of that. Simple pattern. It has stood the test of time. And it works. As long as we don't see strong downside momentum during the corrective phase, we can consider buying once a trade trigger fires off. Now, the ascending triangle, that shows you that people are still buying at higher prices, even though the highest price hasn't moved yet. So what would cause people to buy at higher prices? Well, just like in everyday society, strong demand for something is going to have people buying even as price increases. You couple that with a healthy uptrend, you could be looking at gaining some really solid profits. Now we can see the swing high. We see the price pulls back, and price doesn't just drive back into resistance, but it begins to make higher lows into resistance. Now some have described that as stored energy, but that's pretty silly. There's no energy. It's just buying and selling. What's important is that we're seeing buying at higher prices even before the extreme high was taken out. So notice with the bull flag, we are buying at the end of the decline and as the reversal takes place. Okay, we're essentially buying the turn. The good thing about buying the turn is you already have a built-in area where the protective stop loss can be placed. Now it does get a little tricky when we're considering a complex correction, as you can see here. So just imagine a simple correction takes place, which is this one swing down, and you enter on the strong momentum green candlestick. So your stop will be placed around the low at number 1. Now, price has different plans. It reverses back to the downside. The second push up then gives you a swing low at number 2 for your stop. When we're looking at trading an ascending triangle, what we're looking to trade is a breakout around the last swing high. Now, there are certain things to look for when you're trading breakouts, including a tight consolidation just under the resistance zone. Well, we don't get that in this example, so it's not a really great example of that. There's a video here on trading breakouts. It's going to help you find what to look for when you're looking at this pattern. And there's also a few ways you can place your stop loss, including under the extreme low of the pattern or someplace inside of the pattern. So the important point here, bull flags take advantage of the reversal back into the trend direction. An ascending triangle looks to trade a breakout into new highs. Now, these patterns have different uses, and they take advantage of two things: catching the turn back in the trend direction, breakouts in the trend direction after a tight consolidation. And you can use both of these during a move, or just one that gives you the best odds. So assume you're watching this stock and it's having a lazy pullback. It also gapped down into an exhaustion thrust as it tested prior support. Well, perhaps you just couldn't find an entry on this or on a lower time frame to get in near the bottom. What do? Well, then we see an ascending triangle form. And although we would want to see more coiling action under resistance, you would keep this on your radar for a potential trade in the future. Now, there's 2 in 1 here. Let's imagine you come across this chart. After a one-legged bull flag on the left, we get a 2-leg move to the downside. Your trading plan allows this trade, and you find an entry around that black circle. Price grinds higher. Find resistance on the inside of the extreme high. And I talked about that in the video linked above. We see the ascending triangle, and then we see basing under resistance. Now, these make for higher probability setups, and you enter on the breakout or inside the small consolidation. Price moves higher, and if you extend the dark blue line further, you see our ascending triangle. It's still going on. You see the tight consolidation again, you take an entry. Finally, price does break to the upside, and you have another entry. Well, you're already in profit on both the bull flag reversal and the breakouts. These are 2 simple patterns. They serve 2 different purposes, and I think you should add them to your toolbox. Once you can define the trend, looking for these 2 patterns is going to help you get involved in the upside move of virtually every trading instrument. Are they perfect? No, of course not. But that's why you need to ensure you have a protective stop loss in place. However, trading in the direction of the trend, whether through a reversal to the upside or a breakout to new high, is an extremely viable approach. You can search our channel for more videos on breakouts, chart patterns, and profit targets. And those are going to help you design a complete trading plan. Any questions, comments, pop them below. I hope you hit the subscribe button. We'll talk to you soon.